The title tells you both sides want a deal and the markets disagree. That framing is incomplete. What you are actually watching is a divergence between stated intent and observable behavior, and those are not the same category of information. Before I go further, I want to know where you are watching this from and what your structural reading is. Put it in the comments. Stay until the end, because the consequence I walk through in the final report is the part the coverage is not discussing. Here's what the headline says. Retired General David Petraeus went on television and stated that both the United States and Iran want to end the war. On the same day, Brent crude oil rose 5.5% to $95.36 per barrel, and equity markets declined. The interpretation offered is simple. The general says one thing, the market says another. Here is what the headline missed. These are not competing opinions. These are two different systems measuring two different layers of reality. Let me tell you what this actually is. Petraeus is describing intent, what both sides may prefer in a private strategic sense. Markets are pricing probability, what is likely to happen based on visible actions, not stated preferences. Those are not contradictions, they are sequential layers. Intent lives in private, probability lives in observable behavior. Here is the sequence you need to understand. 30 days ago, diplomatic signaling began around possible talks. 20 days ago, uncertainty remained around participation and structure. Then, in the present moment, two things happened almost simultaneously. The seizure of the Iranian vessel Tuska and Iran declining to confirm attendance at Islamabad talks. Now think about what that means structurally. Consider the geography. A vessel seizure is not a statement. It is an action with operational implications. It affects shipping routes, insurance pricing, and risk calculations. It is measurable. It is immediate. Now consider what a refusal to confirm talks represents. It is not rejection. It is ambiguity. But ambiguity in diplomacy does not reduce risk. It increases it. The absence of commitment is not neutral. It is interpreted as delay. So when markets moved, when Brent crude climbed to over $95, when equities declined, they were not reacting to Petraeus. They were reacting to actions and non-actions that increase uncertainty in the physical and financial system. Here is the part of the story the headline will not tell you. Markets do not price what leaders want. They price what leaders are doing. Petraeus may be correct. Both sides may want a deal. But wanting a deal and being structurally positioned to achieve one are entirely different conditions. Let me be very specific. If both sides wanted a deal and were aligned on pathway, you would see confirmation of talks, de-escalatory signaling, and stabilization in shipping risk. Instead, what you saw was asset seizure and ambiguity around negotiations. That is why oil moved. The market is not disagreeing with Petraeus. It is measuring a different layer of reality. Most coverage focuses on the contradiction. That is the wrong place to focus. The real question is this. If both sides want a deal, why are their actions producing the opposite signal? And more importantly, which signal should we treat as structurally decisive? Here's what the coverage is not explaining. There is no single interpretation of this moment. There are at least two, one in Washington, one in Tehran, and both are internally consistent, but they do not align. Let me tell you how to read both. Washington looks at this situation and sees a familiar structure. Publicly, Iran has not committed to talks. Operationally, there are actions that increase pressure, including the seizure of a vessel. From Washington's perspective, this is not contradiction. This is leverage building before negotiation. So when Petraeus says both sides want a deal, the Washington reading is this: yes, but not yet, and not without shaping the terms first. Negotiations rarely begin at the table. They begin in positioning. Now consider how Tehran reads the same sequence. Iran observes pressure, economic, military signaling, and now narrative framing from U.S. figures suggesting a deal is desirable. But from Tehran's perspective, confirming talks too early reduces bargaining power. Ambiguity is not indecision. It is a negotiating tool. So when Iran does not confirm attendance in Islamabad, that is not necessarily refusal. It is controlled uncertainty. The side that defines the timing often shapes the outcome. Here is where the divergence becomes structural. Washington interprets ambiguity as delay that must be countered with pressure. Tehran interprets pressure as confirmation that delay is working. Both sides are acting rationally within their own frameworks, but those frameworks generate actions that look contradictory when viewed from outside. This is why Petraeus and the markets appear to disagree. They are observing different layers of the same interaction. Let me introduce the historical parallel. The last time this exact sequence occurred, where both sides privately preferred de-escalation but publicly escalated positioning, was during prior negotiation cycles in the region. The pattern is consistent. Signaling increases before talks begin, not after. Escalation before negotiation is not failure. It is part of the process. But here is the critical distinction. In previous cases, escalation was accompanied by clear back-channel confirmation of talks. That is the missing piece here. And this is the data point that changes how you read everything else. There is no confirmed diplomatic pathway visible in the public domain at the same time that operational actions are increasing risk. Think about what that means structurally. Markets are not rejecting the idea of a deal. They are pricing the absence of a visible pathway to that deal. That is why Brent crude moves. That is why equities pull back. Not because a deal is impossible, but because the timeline is uncertain and the near-term risk is elevated. Markets price timing more than intention. Let me be very specific. If Tehran had confirmed attendance at Islamabad talks, even with continued pressure dynamics, you would likely have seen stabilization in oil prices. If vessel seizures had not occurred, ambiguity alone might not have triggered such a sharp move. It is the combination that matters. Ambiguity plus action equals higher perceived risk. Now return to Petraeus. His statement operates at the level of strategic intent. It reflects a long-term equilibrium preference. Neither side benefits from prolonged conflict. Markets operate at the level of near-term exposure. Those are not competing truths. They are layered truths. Both sides can want peace and still produce signals of conflict. Most analysis will focus on whether Petraeus is right or the markets are right. That is the wrong question. The correct question is this: which layer, intent or action, is currently driving outcomes? And right now, the answer is clear. The title suggests a disagreement between a general and the markets. That is not what this changes structurally. What this actually reveals is which layer of reality is currently dominant, and that has consequences far beyond a single price movement. Let me tell you what this actually is. This is a moment where intention has lost control of the timeline and action has taken over. Structural outcomes follow behavior, not preference. Here is what changes. First, the center of gravity shifts from diplomacy to risk management. When markets price oil at $95 and equities begin to pull back, capital reallocates based on uncertainty. That affects shipping, insurance, energy flows, and investment decisions, all before any formal diplomatic outcome is reached. Think about what that number means structurally. A 5.5% move in Brent crude in a single day is not commentary. It is a repricing of near-term risk across the global system. Second, the sequencing of negotiation becomes harder to control. If both sides wanted to move toward a deal under stable conditions, that pathway is now constrained by rising costs of delay. The longer ambiguity persists, the narrower the diplomatic window becomes. Now consider what does not change. The underlying incentive for both the United States and Iran to avoid prolonged conflict remains intact. Energy disruption carries global consequences. Regional instability imposes costs on both sides. Petraeus' core statement that both sides would prefer a deal remains structurally valid. But preference does not determine timing. Let me be very specific. What changes is not the destination. What changes is the pathway and the cost of reaching it. And in some cases, the pathway becomes so costly that the destination is delayed far longer than either side initially intended. Here is the part of the story the headline will not tell you. When markets begin to price risk ahead of diplomacy, they do not just react to events, they begin to shape the constraints within which decisions are made. Higher oil prices affect domestic economic calculations. Market declines influence political pressure. These feedback loops narrow the space for flexible negotiation. Markets do not wait for diplomacy, they impose timelines on it. Now return to the central gap. Petraeus is speaking from the perspective of strategic equilibrium, where both sides recognize that a deal is preferable. Markets are operating in real time, responding to incomplete information and visible risk. The gap between those two is not noise. That gap is the active zone of the conflict. Consider the geography again. A seized vessel, unconfirmed talks, rising oil prices, these are not isolated signals. They are interconnected inputs into a system that is adjusting in real time. And here is the key structural consequence. If this pattern continues, where actions increase risk faster than diplomacy reduces it, then even if a deal is eventually reached, it will occur under worse conditions, higher cost, and tighter constraints. Delay does not preserve options, it consumes them. Most coverage focuses on whether a deal will happen. That is the wrong focus. The more important question is under what conditions that deal, if it comes, will be forced into existence. Because there is a difference between a negotiated outcome and a constrained outcome. One is chosen, the other is imposed by circumstances. Let me close with this. This changes one thing. It does not change what most people think. It does not change the long-term incentive for both sides to reach a deal. But it does change who controls the timing. And right now, that control is shifting away from policymakers and toward unfolding events. Structural forces move slowly. Their effects arrive suddenly. So when you look at this story, do not ask whether Petraeus or the markets are correct. Ask which layer of reality is currently driving the system, because that is where the outcome will come from.